In thinking about different funding techniques for investors wishing to invest in stocks or mutual funds and things like this, they can be broken down into basically two categories. Obviously, there may be more, but two basic categories. Investors may invest in one lump sum, or they may invest in structured payments. So they come with a huge pile of money and they invest, or they say, at periodic times, I'm going to structure a setup where money is sent out and is then invested in the way I want to invest it. So that's the two basic categories of funding techniques. And underneath structured payments, then we have these two options that we're going to look at today. So under structured payments, some investors choose dollar cost averaging, some choose income reinvestment, and in some cases they can choose both. But I want to differentiate these and talk about them just briefly for us today. So in dollar cost averaging, under structured payments, essentially the investor says, I'm going to send a fixed payment at a fixed period of time. So this much money monthly, this much money quarterly, whatever it is they set up. So a fixed amount of money over a fixed time period, the money is then sent in. And at that point, it is invested based on where the market is. So the advantage of this is that there's a fixed amount of money coming at a fixed period of time, but when the price of what they're wanting to buy is lower, they buy more, and when the price is higher, they buy less. And the fixed amount of money controls that, but what that helps do is protect the investor in that it averages out, and they, over the long haul, get the best price. They skip some of the real highs and the real lows. They're not trying to time the market. They're just saying, here's the money coming in. If it's low, obviously you can buy more. If it's higher, you buy less, but it averages out. So a fixed amount of money over a fixed time period is dollar cost averaging. Also under structured payments, some people choose to reinvest their income. So income reinvestment is basically taking dividends, interest, or capital gains and reinvesting them either in that fund or in other things, but usually in that fund or that stock. So instead of taking the dividends, interest, or capital gains as payment, they turn right around and buy more and reinvest it. Mutual funds are already set up to do this. Some corporations do it and actually encourage it by offering incentives, basically saying we'll give it to you at a lower cost than the market value and things like that to try to incentivize the reinvestment of the payoff, the dividends, interest, or capital gains. This money is taxable and usually comes out on the 1099 at the end of the year. So once again, funding techniques for investment, a single lump sum or a structured payment, and then under structured payments, two options we looked at today: the dollar cost averaging, a fixed payment amount over a fixed period of time, which once again, when it's lower, they are able to buy more, and when it's higher, they buy less, but that averaging out helps them miss some of the peaks and valleys. And then income reinvestment, taking the dividends, interest, and capital gains from their investment and reinvesting it back into the fund or stock. If you'd like to learn more about this and related matters, underneath this video, you'll find a link. If you'll click on it, it'll take you to that website with that information. And while you're there, you'll also find a link to an ebook that's ready for immediate download.